Expedia is one stock down 58% that I think you might regret not buying on the dip. Now, I'm going to talk about why I think that's the case in this video, using some financial metrics from the company to describe why I think you might regret not buying this growth stock on the dip. So let's begin. Starting with revenue growth quarterly for Expedia Group, the travel company you see had been relatively stable in terms of revenue growth all the way until the pandemic, when of course travel nearly came to a halt. And according to Statista, travel spending worldwide on hotels and resorts crashed from 1.5 trillion in 2019 all the way down to 610 billion in 2020, a near 1 trillion dollar collapse. And then we had the recovery, but the recovery wasn't what you might think. It didn't bounce all the way back to the level from before the pandemic. In fact, we're still not back to hotel and resort spending back to where it was before the pandemic. Hotel and resort spending is expected to reach 1.1 trillion in 2023. So we're still going to be nearly $400 billion below where it was in 2019. So we're still not back to that level. So you have a company like Expedia that's already rebounded strongly. Look at that strong bounce back in revenue for Expedia. But the overall spending of the industry has not yet bounced back. So you get this company that's going to experience several more quarters of this recovery from the travel rebound, from consumers unleashing this pent up demand for travel. Expedia should continue to capture this tailwind, although, of course, it's not going to be as high as it was during the initial rebound. But you could still expect, reasonable double digit revenue growth from Expedia over the next several quarters. And that's going to come with robust cash flow from operations for the company. Look at its cash flow from operations over the trailing 12 months. 29.48% most recently, and even longer term, it's held this level very nicely, close to, let's go back 10 years. It relatively high in the 20 to 30% range over the last decade if you ignore the brief moment, the dip during the initial collapse of travel during the pandemic. So you got a company that does a good job of turning sales into cash flow from operations. Similarly, with its operating profit margin over the trailing 12 months in the double digits at 10.19%, again at a very healthy rate if you ignore the brief moment during the pandemic when travel came to a halt. So you're getting a company that generates solid cash flow from operations, solid operating profit margins, solid revenue growth. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Everything's solid, nothing incredible, not great, right? Solid numbers. And the final reason that really makes me recommend this stock as one that you might regret not buying on the dip here is its very favorable valuation. Expedia is trading at a forward price to earnings ratio of just 7.897, a very favorable valuation, especially for a company that's got such excellent prospects in the near term. You're getting this stock at the cheapest that it's been going back 15 months. You at 7.897, you've hardly had an opportunity over the last 15 months to buy this stock at this valuation. So for all of those reasons, I think that you might regret not buying Expedia at this significant dip here. So that's all I've got for this video. I hope you've enjoyed this, and I really hope that you'll come back and see me again for another one of my videos next time. Thank you so much for watching.